Hello and welcome. You're watching Business Today TV. I'm Tanya Aneja. Well, we are about to turn the final page of Samvat 2078, and the year was nothing short of a roller coaster ride for the investors. Markets have been volatile amid the Russia Ukraine geopolitical crisis, rising inflation, recessionary fears, and whatnot. But now, as we are all set to enter Samvat 2079, it's very important to learn the art of picking stocks in a falling market. Well, to discuss this and much more, I'm going to be joined by a very special guest today. He's an influencer with over 4 million subscribers on YouTube, and he's also the founder of Finology Ventures. We have with us Pranjal Kamra. Thank you so much, Pranjal, for joining us on Business Today TV.
Thank you, Tanya. Thank you so much for inviting. Always a pleasure talking to you.
So, Pranjal, we are all set to enter Samvat 2079. So, how are you going to approach the markets going forward? And I mean, which strategies one should follow to protect the portfolio amid volatile markets?
Right. So, I mean, no strategy as such. To me, I would forget that the year is changing. We shape our lives in weekly patterns, monthly patterns, yearly patterns, and businesses report their numbers in yearly patterns. But businesses don't work that way. Markets don't work that way. Markets and businesses are not shaped by calendars changing, weeks or months changing. It's a mix of overall what's happening in the country, around the world, and how the business is operating, which is usually unaffected by changes of calendar. So honestly, to me, it's apart from a symbolic gesture of a new year coming, nothing changes at all. I so when we say investing, how should people buy stocks for investing? You buy stocks in investing not for a year, for 3 years, 5 years, 7 years, and thereby, currently in the last 1 year, the hottest international issue was Ukraine-Russia war. But if you look before that, a few years ago, it was Brexit. Few years, 2 years before that, it was COVID. 2020, 2021 was COVID. In India, before that, it was demonetization. So such issues come and go. But if someone would have bought Titan, someone would have bought Colgate, someone would have bought HUL, in the long run, nothing really changes. So nothing specific or nothing special, to be honest.
Okay, absolutely. And also, there are plenty of stocks now trading at double-digit discounts. I mean, compared to their 52-week highs. So, what is the right strategy to be followed when buying a falling knife?
Right. So what I do personally is I follow a few principles that keep me disciplined. One
Okay.
is I never invest more than 10% in a single stock. So if I have 1 lakh rupees, I'm buying the stock. I'll not buy more, invest 10 more than 10,000 rupees in the stock. And also, you know, at one go, I'll only allocate 40% of my total planned allocation in that stock. So if I'm supposed to invest 10,000 rupees, I only start with 4,000 rupees. Now, if the stock falls more than 25% from my buying price, I buy 30% more. So 3,000 more I'll allocate. If from there again the stock falls more than 25%, I'll complete my allocation of 10%. Now, if after that the stock falls, no matter how much it falls, I won't allocate any incremental money, because then I'm putting all my eggs in one basket. So that's my discipline. In most cases, it has worked. Sometimes, this will happen, that because of this discipline, you'll miss out on buying your favorite stock at a really cheap level and you'll regret it
Right.
later. But this strategy will also save you from disasters. When the company is really bad, but you have invested a lot of time and effort in analyzing the company and you think it's right, in such cases, if the company actually turns out to be bad, you will save a lot of capital. So over the long term, I think this discipline works for me.
Okay, absolutely. Also, Pranjal, if someone is planning to put, let's say, 10 lakh rupees right now across different asset classes, so which is the ideal medium according to you, and what should be the ideal asset allocation strategy?
Right. So while this depends a lot on the individual, what age profile, what risk
Yeah.
profile, how many dependents are there, how many existing loan is there, and things like that.
Yeah.
In general, just to give you a thumb rule, sort of, that if someone is say 25 to 30 years old, not married, planning to get married, no loans and things like that, and someone who's earning say 60, 70, 80,000, above 50,000, a general thumb rule that I would do for me would be, probably divide my total investable corpus in four parts. One part I'll invest in mutual funds, one part I'll invest in stocks directly, one
Okay.
part would go towards sovereign gold bond, and one part would go towards my retirement planning through NPS. So in
Okay.
general, if someone is not comfortable with stocks, then he or she could alter it to one third in mutual fund, one third in NPS, and one third in sovereign gold bonds. I think keeping it simple is the key, and remaining invested is the key. These are, rather than you choosing sovereign gold bond or mutual funds or stock. What's
Hmm.
important is that we invest with discipline and we keep invested, and more or less all of these asset classes would give you somewhere around the same return, 1 or 2% here or there.
Okay, absolutely got that. And also, I mean, we all want to have multi baggers in our portfolio. I mean, how should one pick long term wealth creators? How do you pick your long term wealth creators? What filters do you use?
So, I think multi-baggers are always in hindsight. You
Hmm.
cannot predict multi-baggers. One approach that I follow is I don't chase multi-baggers. I don't chase future leaders. I don't chase future stars. I do the opposite. I
Okay.
chase survivors. The first question that I ask myself is not if this company will do well. I ask myself, will this company survive after 5 years? If I gather 20 survivors in my portfolio, companies that I think won't fail, automatically 20% of them will turn out to be multi-baggers. The problem is, if we have 20 stocks in our portfolio, after 5 years, we find out that 10 of those don't survive at all because those were riskier bets. So my focus is always on answering the question, will this company survive for the next 5 years or will it go out of business? If the answer to that is yes, this company will definitely survive, I'll buy that stock. And 20 such companies, four will turn out to be multi-baggers.
Okay, absolutely. And also, rate hikes are also happening. So, what should be the right portfolio mix amid rise in interest rate environment, according to you?
Right. So, I have always believed that as individual investors, it's important that we keep our investing portfolio really, really simple
Yeah.
because, we have small amounts to invest, say 5,000 rupees, 10,000 rupees. And, if you spread that too thin, it becomes difficult to track. And overall, if you look after 10 years or 15 years, the difference in return by spreading that thin is not really appreciable. So first focus is simplicity. Either
Okay.
you are ready to take the risk that equity offers through direct investing or through mutual funds, or you want to diversify through gold, or you stick to the safety of fixed deposits. These days, again, fixed deposits are offering close to 7%, 7.5%. Some banks have
Right.
started offering that.
Hmm.
Bonds with increase in interest rate would probably offer you 1% more. I don't think it makes sense for the retail investor to figure out which bond to buy, to figure out if bonds are right for him or her, to predict the interest rate cycle and things like that. 1.5% is really not worth the risk. And if you really want to risk it, go a step further, invest in sovereign gold bonds, or go a step further, invest in equities, or stick to safety. This mix and match approach sort of leaves you nowhere, hanging in between. And so I don't think bonds are for retail investors in most cases.
Okay, absolutely. And lastly, before we let you go, I mean, what would be your advice to all the young investors? I'm very sure they all want to make good amount of money in the markets. So, any mistakes that they should avoid at this point in time?
Ah, I mean, one thing I said regarding, investing, chasing the next heroes. That's one thing that a lot of youngsters do, and because it comes from trying to sound cool, trying to look and stand out of the crowd. If you say that I invested in Colgate, you're not cool. But if you invested in
Yeah,
Tesla, you are cool. That itch, I had that itch. I would tell my father, my friends, I figured out this stock. It's a penny stock. It's going to be a multi-bagger. And then I would explain my hypothesis. See, I researched this much, and everyone would appreciate the research because no one knew about it. So if no one
absolutely.
knows anything about the company and I'm providing that information to them, they appreciate it. If I tell them Colgate makes toothpaste and toothbrushes and is the market leader, they would ridicule me. Ye kyun bata raha hai? I know that. Things like that. So I think youngsters have that itch. Controlling that itch and doing investing the old boring way will continue to give good return.
Okay, absolutely. That's the word coming in. And on that wonderful note, thank you so much for taking the time out and being with us here
Pleasure.
on Business Today TV. And also, here's wishing you a very happy Diwali in advance.
If you like the video, do like, comment, share and subscribe.